Let's connect with Bhanu Baveja, Head of Research with Emerging Market Strategy, represents UBS. Bhanu, good morning. Thank you for joining us. Bhanu, we're getting mixed feelers when it comes to global growth. US economic data has improved. Europe is static and China is slowing down. So what is your assessment when it comes to global growth?
Look, I think that one thing that investors need to understand is that this is not a cyclical slowdown. The slowdown in Europe, the slowdown in US, and most importantly, the slowdown in China and India as well, is a structural slowdown. This is not just an inventory cycle. Why is that important? Because counter-cyclical monetary policy is unable to handle this slowdown. It's called counter-cyclical because it counters cycles. And if I'm saying to you that this is not a cyclical slowdown, it's a structural slowdown, I'm also saying to you that the efficacy of monetary policy in this cycle is very limited. Because certainly for the developed world, not so for India, but for the developed world and China, this is a balance sheet slowdown, which means for a long period of time, we are going to be at subpar growth, right? Now, the markets are not trading like that. The market trade quite well. And that's because we have the liquidity. But the potency of that liquidity, certainly in the case of US, is declining. And that, I think, is material for volatility. That, I think, is material for markets. Now, China, I think, is an underestimated force, right? It was the growth provider of last resort for the last 10 years. Just like Fed was the liquidity provider of last resort for the last 10 years together, that was a very potent combination, and the markets were very, very heady, were inebriated between 2003 and 2007, 2008. Now, the Fed is still there with the liquidity. I think the power of that liquidity is declining, but most importantly, China's output is falling, and I think that fall is structural, especially Chinese investment. So there are quite a few things for long-term investors to worry about. I'm not surprised people are worried about growth, but there are not many assets that are reflecting that. Some parts of the commodity space, such as iron ore, steel, copper, are beginning to reflect that. I think there's a lot more to run.
Bhanu, hi, morning. Historically, we've always seen that every time global growth is poor, equities tend to outperform. Is that something that you're witnessing now as well?
And I think the fixed income outperformance will probably continue for some time longer. And if I could pull this to the Indian context as well, I think the Indian equity market has held up better than growth has had it deserved, or also better than I would have expected. Moving from here, I think that on the next 2 years, I would be bearish on equities relative to bonds. I don't think Indian bonds are a great buy. In the absolute, I think both Indian equities and Indian bonds are in fact expensive. But between equities and bonds, I would prefer bonds in India. If you think about a simple calculation, let's say the PE of this market is between 13 and 14, which gives you the earnings yield at about 7 to 8, which is just the inverse of the PE. The earnings yield from the equity market at 7 to 8, your bond yields at 8%. That means that there's not much to choose between them, and in that case I would certainly go for the low vol trade, which is the bond trade, right? So I'd certainly be long duration, be long bonds. By the way, if you compare this with other global markets, bond yields are 1/4 of earning yields. So in India, bond yields are relatively much higher, and that's why I think bonds over equities is the right asset allocation call, certainly in India.
Bhanu, so you're bullish on Indian debt, but historically, fixed income products and debt instruments, they always tend to outperform when there is possibility of a rate cut. But given the way how structurally inflation is a problem for India, it is highly unlikely that in the near term we will get a rate cut.
I absolutely agree, which is why in the absolute I don't think bonds are a great investment. I just think relative to equities they're a better investment. Now, it's no surprise that large parts of the retail universe have not gone into equities in a big way. What are these people doing? They're going into gold. Retails are going into gold. They're going into fixed deposits. And they're going into fixed income products. They're not going into equities. And I think that trend will probably continue for a while. The RBI is unable to cut rates very aggressively. In fact, my sense is that they were uncomfortable cutting rates 50 basis points earlier this year when they did as well. One of my big gripes about the Indian economy really is that there are supply inelasticities in this economy, as a result of which inflation has become persistent and it has become structural. What we are doing with wages in rural India is great for income equality, as long as productivity also increases. And the problem is that we have increased wages, but productivity, specifically agriculture productivity, has shown no signs of improving. It's early days, that can change, but on current evidence, I'm not very hopeful that that will change anytime very soon, which means inflation goes up and output doesn't. That's not good. That's not good for productivity, it's not good for the markets. I think RBI's room to cut rates will therefore be limited. However, the long end can do reasonably well if growth continues to decline, so I think the curve can stay flat or perhaps become more inverted. Certainly outperform equities, which is the point I've been making.
Bhanu, many observers feel that at these levels, all the bad news for the Indian markets are priced in, and the only way the markets could go is up. Is that something that you believe in as well?
And I would disagree. I don't think all the bad news is baked in, because if you look at the equity market, it certainly doesn't trade like all the bad news is baked in. Granted, there are different parts of the equity market that are doing very well, which is the consumer staples space, which can continue to do well for the near term. And then there's the investment space, the infrastructure companies and the banks, which are doing very, very poorly. The question is, can the infrastructure space or the banks come back very quickly, or can you see consumption space suffering? It's a difficult call, I have to say, but I think that consumption is not independent of investment. Consumption, after all, is dependent on growth primarily, and if growth is reducing, you will also see some consumption stories getting compromised. So I do think that not all the bad news is baked in. Certainly, a downgrade is not baked in, right? And I think a downgrade over the next 3 to 6 months is a high probability event. There's a southward drift in India, right? That we are unable to address fundamental issues of government expenditure, the form of government expenditure. We're unable to address fundamental issues of inelasticities in agriculture, of being unable to absorb surplus agricultural labor into manufacturing. And these issues are not going away unless we are willing to reform right now. What we've learned over the last 25 years is that India reforms when its back is against the wall. India's back is not against the wall. There's a lot of room for southward drift, as I said. Your bond yields are not very high. The rupee is not under distress. It's under some pressure, but there's no distress out there. And certainly the equity market is trading much better than I thought it would be trading. So I don't think all the bad news is in the price.
Anu, finally, how exactly are you mapping the consumption growth in India? Because rural consumption has been strong, but if I map urban spending, auto sales are down, retail sales have plunged, and the kind of indications we've gone from urban vendors, things are not looking very encouraging for Indian consumer.
I think the bigger call out there is going to be, I think consumption in India is going to weaken, right? Consumption has held up very, very well. I think one of the things holding up consumption in India is the fact that you have seen massive payouts into rural areas, and that's where real incomes are also rising. But as I said to you, if investment is going to lead GDP lower, investment goes lower, incomes go lower, and then if overall income is falling, consumption also must fall. So yes, I do think that consumption is going to be weaker.